Hello and welcome to another financial analysis video. A Seeking Alpha a Seeking Alpha user reached out to me and asked me after my Kinder Morgan dividend video if I would review Enterprise Products Partners, ticker symbol EPD, which I think, well, I'll just refer to them as Enterprise from here on out, and look at their dividend and ask or answer as to whether or not it was sustainable. And so I'm going to pose that question. And I learned a few things from the Kinder Morgan video. Some people were very upset because I felt that a dividend cut was coming in Kinder Morgan's future. But I want to talk about Enterprise in greater detail as it pertains to cash flow in regards to the dividend. So let's go ahead and have a look. As you can see, the stock really took a nosedive late last week and then bounced back. So if anybody bought that on the dip for the first time, kudos to you on a nice little return. Now the dividend currently is not doing anything earth-shattering. It's at 5.5%, although with that dip late last week, the yield actually was up around 7%. And this is a company that adjusts its dividend quarterly. Most companies will announce a dividend and they will reiterate it for a 4-quarter period, and then they look to adjust it. But not Enterprise. They do it they raise it on a regular basis, and so do some real estate investment trusts as well. So it's actually a good practice because it keeps the status of the dividend really current, and you could tell how committed the organization is to paying its shareholders. I'm going to move now to the trailing 12-month income. Again, this is where some people got upset with me in the Kinder Morgan video because they didn't like how I had presented this. We're going to drill down a little bit deeper in a little bit so you could see that the company has obviously been affected by energy prices. This is in my opinion, well-diversified energy company. They do a lot of natural gas, a lot of oil. They do some stuff with pipeline and storage and transportation. And so it's a company that obviously is going to be hurt in this market. They're going from $50 billion on trailing 12-month to $37. That's pretty substantial. However, management has done a good job in the operations of the organization, and cash flow has actually gone up and then maintained itself really in that period. Capital expenditures have also slightly increased, and you can see over here free cash flow before the energy price crash was around $1.26 billion on a trailing 12-month basis. It's now around $847 million. And so we're going to look at about $800 million as the sweet spot here for free cash flow. And now I want to take a look at the dividend. I'm going to move to here and have a look at the dividend. And again, I look at the 4 quarters of what's been paid out, and it's around $2.9 billion. So the dividend that's being paid out is greater than the free cash flow. Now, without getting people too riled up here, I'm going to look at another statistic. I'm going to present it in 2 different ways. And then we're going to take a look at the cash flow statement, and I'm going to show you sort of how the company is doing this dividend payout, how they're sustaining it. And then I'm going to give commentary on how long I think this practice can keep up. So the free cash flow test doesn't work well here, doesn't give us a good outcome. However, they are still raising the dividend. I want to draw people's attention to the payout ratio. This is the percentage of earnings that are paid out. So it's the dividend divided by the earnings. And it was 50-60% in 2011, and late 2012 it got a little dicier as earnings were hurting a little bit. But now it's flirting with that 100% mark, and for the last 3 quarters the payout ratio has been over 100%. So the company has paid out more than it has earned for 3 consecutive quarters, and it has already declared a 39-cent dividend for the next quarter. So the likelihood that it's going to meet that is very low. We're probably looking at 4 straight quarters of that higher, over 100% payout. So from a payout ratio side, this isn't working either. Now I want to take a look at price to book. This is another way. We're going to do the exact same calculation we did. We're just going to do it with other information. 2.6 is the price to book. And basically what that means is if you take the price to book ratio, 2.6, and multiply it by the dividend yield, it's 14.25%. That is the return on equity that you need in order to meet the dividend yield, because essentially the dividend yield is on top of, well, it's trading at a premium to price to book. And what I'm basically trying to do is put return on equity and dividend yield on equal terms. I'm adjusting it to reflect a similar value in the price to book, or excuse me, not the price to book, in the equity value in the market capitalization. And so when we take a look at that, we see that the return on equity right now is at 13.86%. So in order for that to, and that again, if you take those numbers and divide them by each other, you're going to get the same payback ratio. So if you take 13.86% and you divide it by 14.27, excuse me, it's the wrong way. It's this divided by this. You get 103%. That is essentially the average of these last 4 quarters. It doesn't work out totally in that manner, but again, it's another way to look at it. Those two numbers are always going to be close. So how is this happening? I guess the radar kind of bubbles up for me when I look at this, and I know people are going to talk about the limited partnership aspect of it, but I want to take a look at the cash flow statement directly. And so I'm going to bring my browser into this picture. And the segment here that we're going to look at is right here. This is the Centio website, and they provide the cash flow information. And as we drill down, this is Q1. And the reason I'm going to focus on Q1 is because cash flow is presented on a year-to-date basis, and I want to keep this as quarterly as limited as possible in terms of time scope. Financing activities. So 2 things are happening here, and this is outside of the purview of free cash flow. Right here, the company is borrowing money and repaying debt. So what they're doing is they're recirculating their debt structure, essentially. They're paying debt that's coming due, and they're issuing new debt. And they're doing it in a positive cash flow nature. They've tightened that up since a year ago, and they've done it a lot more. But the company is not very leveraged, so they can do this and they can be okay. The next thing I want to draw your attention to is down here. Cash proceeds from the issuance of common units. They are issuing stock. And in the first quarter, they did it to the tune of almost $500 million. They've been doing this for a while now. This is their way to bridge the gap of low energy prices. And I want to look right here at shares outstanding. 1.7 billion shares outstanding 4 years ago. 2 billion today. So they've increased that by about close to 20%. And they're going to continue to do this, in my opinion, in order to keep the dividend and to keep the dividend attractive. I want to go back to the yield again, which is now at 5.5%. So here's how I'm looking at this. I believe that energy prices are going to go up in probably about 2 years. I'm hoping that Enterprise agrees with me, because I think what they'll continue to do is they'll continue to rotate their debt, and they'll continue to issue shares until energy prices bounce. They'll stop doing the share issuance part, and they'll continue to rotate debt. And like I just said earlier, their leverage has improved. The The debt aspect of this doesn't concern me that much, believe it or not. The common shares being issued somewhat does, so I will keep my eye on that a little more. However, with all that being said, and I'm over the 10-minute mark here, I'm on a hold with this stock. So if you own it, just hold on to it, sit tight, wait for energy prices to bounce, you'll be okay. I'm in a position with all the longs I've made in the market that I'm only looking for short-term opportunities right now and possibly looking at corporate bonds. So for me, this is not something I want to get into. I also don't know where the price of this is going to be if they continue to issue shares. This may be something I look at later in 2016 when I feel we're towards the end of the energy bear market, hopefully. So I hope you enjoyed my analysis of this. I typically don't go this long, but I did it for this particular person who asked me to, and I'm happy to take any more requests in the future. Good luck investing.